Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome to Money on Tap. We are so glad to have you aboard today. My name is Seth Krusman.
And I'm Ben Brayshaw.
So, folks, here we are, election season. That's
what did you say? Election what? What are we doing? What's going on?
It's an election year. It's election season. You can run, you can hide, or you can stand here and face it. Whichever your choice is, it is all around us. But it is not what we're going to talk about today on Money on Tap, is it?
No, because that would turn the dial for some, I'm sure.
Yeah. There's no right enough. There's no left enough. And that's not our show.
Yeah,
that's not what we do.
That's not the one today.
No. So Money on Tap. That's a lot of fun for us. We're financial planners. That's what Ben and I do at Brayshaw Financial Group. And if there's an introduction for us to make here, it's basically like this is our side gig. This is our side hustle. Right, because we paid attention and told our kids, go get a side hustle. And then Ben and I looked at each other and were like, what are we doing? We need a side hustle. We need to have some fun with this.
If anyone really knew how this radio show came about with everybody, it's pretty funny. But we love doing this. Next week we're going to have Dan on too. And looking forward. Eric said he wants to be back on more often. And there's a bunch of planners, a bunch of insurance agents.
Sarah,
right. Everybody wants to partake. So, but this week it's just Seth and I, and we love having the mic without them sometimes.
Yeah, we have no problem filling the airspace with just us.
Our comrades.
Anyway, our kids know that very well. Gosh, you know what? I was just sitting down with Spencer the other day, and I had to realize, I was like, how long have we been sitting here talking, and how much of the space have I been filling trying to help my 15-year-old grasp something that just isn't quite there yet for him? Less is more with that some days, right?
Yeah, a lot less. Yeah. It seems to be like a lot more. But, hey, I'm really excited about the show today, Seth. I mean, we have some of the most overlooked tax deductions ready to come your way right after Money in the News. And I'm pretty excited to go through these because, as we kind of approach the end of the year, it's still time to do stuff. It's still time to consider stuff. A lot of people don't do that. I always talk to people like, when was the last time you talked to your tax advisor? And they're like, well, it was, April 1st, we were kind of going through some stuff. And I was like, oh, he was crazy busy and didn't have time for you barely. And they're like, yeah. I said, well, when you want to talk to them is after October 15th, when they filed all their extensions and they've got basically a few months of dead air. They want to meet with people. They want to talk to people. They're very friendly.
October 15th. Are there more extensions for October 15th that I'm not aware of?
No, that is the extension.
That's the end of the extension.
That's the end.
No more extensions. Good.
That's all you get. But this is the time when you can literally step out, call your CPA, and they'll probably personally pick up the phone and be happy to take your call. It's one of those times. And this is a great time to kind of cross that road with them. So we're going to come up with that right after we have Money in the News. But if you have questions, you can reach us at 855-226-8551. And you can email us your questions too at info@yourmoneyontap.com.
Companies give up cash cushions to buy back debt by Anna Hertenstein. And this is an article that we love the Wall Street Journal because they give us so much great information that we get to bring to you or highlight and discuss because it's not much of a discussion when you're reading the article, but that's what we're going to do. What's going on with company debt buybacks?
Seth, this is a great article. And it's funny when you mentioned the Wall Street Journal, I'm kind of a little old school. I still get the Wall Street Journal in my office every day. Physical paper.
That's a paper?
It's a paper. I get that. I have the online subscription, but every day I see that Wall Street Journal. And, it's just a great piece. I mean, I don't agree with every political slant they have either way, but it just has a lot of really very interesting articles about the financial world, which is why it's the Wall Street Journal. And this article particularly popped out to me. And, with all the stuff going on in our economy and in the world, all these companies have been basically selling bonds, and we hear about it. They're selling various instruments to create as much cash as they possibly can. And this article goes into the fact that a lot of these companies are kind of 6 months later or 8 months later realizing we don't need this debt. Yeah.
Or it's too expensive. The mechanics of it and the payments on the coupons are just too much in comparison to having the liquidity, right?
Yeah, and some of the companies that are listed here are like AT&T, Anheuser-Busch, BP, the big oil giant. There's lots of different things, and it's cited that they really understand that there's just more visibility to the whole COVID thing. We don't need this cash right now, and on top of it, what's something I really didn't process, the double whammy that happens here. Like, yeah, interest rates are really low, so they're borrowing this money at exceptionally low rates, but they're storing the cash in banks that have potentially negative yields. So in Europe, some of these banks which are paying less money, if you put your money in for 10 years, you're going to have less money. You're paying money to store this money. So not only are they paying out their dividend yields or whatever coupon they have associated with any item here, but they're also paying a fee to the banks to store this cash. So it's a double whammy that I hadn't really processed. In the U.S., that's not happening as much or at all, really, but in Europe, it's really happening deeply. And these companies have realized that this is just not relevant anymore for them. And go ahead.
Yeah, I was going to say one of the things that pops off the page to me is as we read off the names of the companies in the article, what stands out to you here is, and this is a question actually for you, Ben. There's AT&T, there's BP, there's AB or in beverage, and that's BUD. There's British American Tobacco, and cyclically, if we took a look at those, if we were to take a look at what happens when you go into recession, and what are the places where people typically will go towards in a cycle of investing. These are all names that are included with those types of that style of investment.
Yeah, very recessionary thinking for the most part.
Right.
Yeah, not entirely, but yeah.
Yeah. And so those would be the actual companies that would historically kind of benefit from a pullback in the market are the ones that are going out and raising and raise cash.
I mean, other than BP, yes. I mean, ironically, because COVID, shut everything down. So we're not using oil. But, good point, Seth. And I think at the same time, too, we're not really evaluating how much. We haven't even mentioned, these companies didn't take a few $100 million bond offerings here. And British American Tobacco took a $9 billion debt offering. BP raised $20 billion. AB InBev raised $11 billion. I mean, this is not small numbers, folks. This is huge dollars, and they weren't hesitating on it.
Did you say BP $20 billion?
$20 billion. Yeah, as in boy. I mean, this is crazy. I mean, I think what really comes into play at the end of this, right, is that these companies, what if things get worse? And one of the things that was stated by one of the people quoted in the article was that, and it's generically correct, is that the interest rates are been said by the Federal Reserve here in the U.S., the Bank of England, I mean, all the different global Fed managers essentially have all said they're going to keep rates low or even lower them further. So the idea of being able to, if they could raise $20 billion today, that they could potentially raise that in a year or two if they really needed it. That's a big deal.
Mm-hmm.
That's kind of a, we know we can do this and we don't need the money now and we can probably do it later for the same rate and save ourselves kind of the hit. This is a good opportunity for us to get rid of it. And I think it makes a lot of sense, and it's great. It shows great strength on behalf of these companies.
I'm curious to see how it expresses itself in the markets, in the bond markets, right? In the corporate bond markets, as well as our typical markets that we look at in S&Ps and the stock market, right? All of your favorite household names today, which have been dwindled down to 4, which are Amazon, Facebook, Alphabet, and that's Google, folks, and Apple. Well, they are in the process of being disclosed or uncovered as monopolies.
Yeah, the government's subpoenaing them, and they want them to start talking.
Yeah, and this is an article by Ryan Tracy, Wall Street Journal again, folks. Democratic-led report concludes after 16-month probe that Amazon, Facebook, Google, and Apple stifle competition. And Facebook and Google are basically monopoly powers, according to the report. And Apple and Amazon have significant and durable market power. And and they seem like they're splitting hairs in the differentiation here.
Yeah, Seth, break that out for us.
Do my best to try to do that, but monopolies. If you take a look at the history of monopolies and the antitrust laws that we have here in the U.S., where railroads were a monopoly at a point in time, and Ma Bell and the telephone companies were monopolies, and what they had to do in the process of creating competition and fairness was break them up. And so that's where you got all the Southern Bell and all these different phone companies that happened. And it's been a consideration recently when you've seen some of the cell phone companies coming together, like AT&T, or not AT&T, but T-Mobile and Sprint in a merger. Are they basically creating a size and scale that eliminates competition and creates an environment where they can set the price and control profits and can basically squash the ability of another company to operate or do business in that same space. So,
yeah, I mean, that's what's really interesting, Seth, is that it's not just like, hey, we have one and we need two. The perspective is it's very much just the opinion, essentially, of the government on what is a monopoly and when it occurs. Like, if we only had 3 cell phone providers in the country, they could theoretically gang up against all Americans and charge something within range. Or is there enough companies that someone's biting for more business and therefore is going to become competitive? So it's not just we need 2 or 3. It's whether or not it creates enough rigidity in the market that one company's fighting for someone else's business.
Yeah. The quick differentiation here that is interesting, and we're not exactly sure how much this brings to bear in terms of what they're trying to legislate here around the antitrust laws, but it's that market power. And what is that? It basically refers to a company's ability to manipulate the price of an item in a marketplace and manipulating the level of supply and demand, or both. And that's where Amazon is at, and that's where Apple is at. Is they're saying these companies have the ability to create their own profits in a sense, and eliminate the ability for other companies or other manufacturers to enter into this market space because they control that.
Yeah, the market power is significantly scarier and much more problematic. It's kind of like we're already past the monopoly. That's how I see it. I mean, that's probably not the official definition that they're pushing off here, but it's not that there could be a monopoly. There is a monopoly. They are the power. They set the price, no matter what they want it to be. If they decide an iPhone is X, it's Y. Even though you have Androids and all the other options you can do, if you want an Apple Watch, there's only one company that makes Apple Watch, and that is what it is. And whatever they decide they want to sell it for, if they want $5,000 for it, they're going to charge $5,000, and there's nothing you can do about it. And that market power is very, 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 very scary. And I think, as technology becomes, more symbiotic, in its relationship with other technology, maybe that wears off. Maybe the Android works the Apple Watch, and that creates some opportunity and vice versa. But the fact that there's this, very incestuous relationship between technology, and you go in this branch or that branch, and that's all it works with, that creates a very complicated scenario to break up market power. And that's, but there's a lot of, technology there that no one's going to give up to connect with on some level too. So that's problematic. And I don't know what the solve is here, but there definitely is an issue. And I think the government's right to step in and say, hey, we see there's something here. I think the general population of America sees it too.
So the article states basically that this was a Democratic-led report, but it is of note that there really is a Republican response here happening as well, endorsing the enforcement of an antitrust targeting companies, but it didn't necessarily endorse a lot of the Democratic policy prescriptions here. Nothing terribly new there, but both parties are really in line with saying, hey, this is an issue. It's significant. And when you take a look at the underlying numbers here of how profitable these companies are, we have never seen anything like it. The profits and scale of these profits are so astronomical. And I think that's it, and the influence that they have over us as a culture is part of it as well. And that's a kind of a separate issue. That's kind of the moral issue here of how much control do they actually have over us in turning our attention in directions that they dictate or the money dictates we will go.
Yeah, I mean, you can't use. I mean, you can't put a phone down for a day without someone, saying, "Well, you weren't getting back to me," and being upset if they expect you to do that. And if you have an Apple Watch, it's going to send its text messages through the watch, so it's impossible that you could have ignored me in pure speculation of not noticing. There's so much connection here, and that life control is a little bit overwhelming. Say, oh, well, I took my watch off too for the day or for the week.
I'm putting my watch back on right now as we speak.
So that's one of those things. I mean, it's so connected at the core, but it's just a little bit scary, Seth. I'm gonna take us out of here. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. That does it for Money in the News. We'll be right back. We have a great show here to finish out with. Some of the most overlooked tax deductions as you walk into the end of October and getting ready for next year. Stay with us. We'll be right back.
Hi, my name is Seth Krusman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, and we are going to get into the heart of the show today, folks. We thank you for joining us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And one of the questions that we get from you is, we get the love the show. We wish you would spend more time talking about the topic. You guys give us feedback that's great. Sometimes we have such great money in the news things to talk about, and we get so focused on our topic and the front end of it, we don't have time to really get through what we intend to all the time. And sometimes it's because I'm doing this kind of stuff right now as we speak. And so without that, I want to just thank you guys for being here with us today and say we're going to get into some tax deductions because it is that time of the year. There's possibly some last-minute maneuvering that you can do, and there's quite a few that people consistently forget about or just don't even know about. And we want you to know what you can bring to the table to try to save yourself some serious dollars this season.
Well, hopefully we're not bringing this too late here. October 15th, we're right there, and we may have missed you on some of these items, but, like I had said earlier in the show, this is the time to go see your CPA, right, Seth? I mean, they're dead. They got nothing to do, really. They're
after the 15th, they pretty much are.
Yeah.
You might want to give them a week to recover if you can.
Yeah, well, I mean, they had the summer.
That's true.
So you can usually reach them, well into like June. June and July, they're pretty much dead for the most part. Uh-huh. And then right after October 15th, they're dead. They got nothing going on. Not literally, but they have time for you. They'll pick up the phone. They love to talk to you. But right now they're just finishing up that last round. So, but I got, Seth, we went through this, and I've got a lot of these on the list that we could probably bang out here, but we have 6 we're probably going to be able to cover today. And if you're looking for more of these, we're happy to sit down with you, go over it. There's a zillion of these things out there, but we wanted to bring things that might be relevant to today. So we have a couple of interesting ones that I think are going to surprise people. But I'm going to start off first. And the first one is reinvested dividends. This is probably one of the most overlooked issues we find out there. People buy a stock. They have mutual funds that are reinvesting dividends. They have all sorts of things, and they're getting taxed on these dividends every year. And what people usually do is they end up getting double taxed. And the reason I say that is because when you reinvest dividends, you're going to get taxed on those dividends in the current year. But if you don't add those dividends of what you reinvested to your cost basis for when you sell that mutual fund or stock later on in the future. So if you put $100 into an asset and you're getting $1 every year for 10 years, okay, and you're paying taxes on that dollar every year that you got, well, when you go and sell the asset, and if it's $120, the cost was not $100 anymore because you paid taxes on that dollar every year for 10 years. So now your cost is $110, and you sold it for $120. So your real gain is $20. What a lot of people do is, and this happens all the time, they say, oh, well, I only paid $100 for that asset, and now it's $120, so I made 20% of gain, not the, roughly 10 that the other option would be. And so they end up getting double taxed. And that, Seth, I don't know how many times that probably happens to people on a regular basis. And I've had people call in and say, hey, I need my dividend reinvestment report. So we'll provide stuff like that. And we know people are catching it. But a lot of times people don't. And in some of the older brokerage accounts, some of the smaller accounts didn't ever keep track of that cost basis. So some of these really old mutual fund and stock assets, that dividend reinvestment is, it could be 50 years old, literally.
Yeah. Yeah. And doing a forensic accounting on that can that can take a little bit of time in doing it. It's interesting to talk to the fund companies and ask for some of these reports, and so many of them just can't even provide that information anymore. They will give you something, but boy, is it ever a fun job to kind of dive back into the history of a fund and try to understand where those buys happened at what levels and those distributions.
I'm going to one up you on that story, because I had a gentleman. He's in his 90s, great guy, and he started putting $25 away in I don't know, some mutual fund company that basically commingled, became another company. I think Evergreen was in that mix too, and they were, he was part of his holdings, and then went to another company, and I mean, it was like 4 different companies, and we went back, and they have no records at all, none. And he's got mutual funds worth hundreds of thousands of dollars from having done that. So, if you can learn anything from this, putting $25 away a month, it can add up quickly. I mean, right, with growth and reinvestment and all of that, but he's actually tax trapped. Because he doesn't have a cost basis. So what you'd have to declare is whatever you knew for certain, which would be just what the $25 a month, and add that up. But now he's got hundreds of thousands of dollars in those mutual funds, and the gain would be enormous. So he has to literally pass those on to his family when he dies, because that's the only way he's going to get a step up in cost basis. And we've talked about that in the past, where when you die and you pass it on to your children, your cost basis becomes the current value on the day of your death. So his couple $100,000, his cost basis could be $50,000 or $20,000, but when he dies, it's going to be the couple $100,000 it's worth. So reinvested dividends is a significant, major overlooked item when the double taxation happens when you go and sell that asset. And that's something you really need to be heads up. And the reason we're bringing this up this year is because in 2020, the stock market went down because people were selling. The stock market went down to 18,000 on the Dow because people were selling investments. And that means you're going to have sales probably inside your portfolios that you need to know if you are reinvesting those dividends or not.
There you go. Number 2, job hunting costs. Well, a tough job market can mean you're looking all over the place for employment. You might, well, this year flying may not have been as much of an issue. You might be Zooming more than ever, but you could be looking at all sorts of costs that are included in the transportation, food, lodging, any of those personal car use, printing costs. All of those things can be considered tax-deductible expenses. So providing that the search is not your first job.
It's interesting, Seth. This would never have been on a top 10 list for me to do on a show.
No.
I mean, right? We were like, this is something that people don't know about. This is an issue that people don't have any clue that exists, I would say. I would say most CPAs don't even ask this question when you're talking to them, right? I mean, hey, were you looking for a new job this year? Well, 40 million Americans were at one point. There's real potential issues there inside of like, I've lost my job. What do I need to do now? And so that's something that I think a lot of people aren't really aware of, is that I'm unemployed, and what's it going to cost me to get a new job? And how is that going to impact me? Because honestly, when you have deductions like this and you have a low income tax year, it might be worth doing a Roth conversion this year. It might be worth saying, hey, you know what? I can do a Roth conversion for a little bit of money because I have all these write-offs that, from finding a new job. And I never knew I could deduct those before. And so just a great little tidbit item for people, because sometimes getting that next job can cost you a lot of money.
So one of the things that might be overlooked or to consider in that job hunting cost is you might be working with an executive coach, somebody that's an advisor to you, of how to position yourself either into a new marketplace because you're maybe going through, a bit of a reinvention process, or you might be really trying to headhunt into some very specific verticals. And so those are some of the people that you might be utilizing in your process, more so than even the travel at this point. And so that's one of the expenses that gets overlooked as well.
No, that's a great point. Number 3. Okay. Out-of-pocket charity. Okay. Now, the thing that we bring up here is that people have become inventive in the charitable giving world because sometimes, you don't have the money to give, but you have an asset. Because it's not just the cash donations that are deductible. If you donate certain assets, whether it's a car, if you want to donate stock, there's just different types of things that people are donating versus just a straight check out of their checkbook. I had one client call me and make a charitable donation of some appreciated stock. You donate the stock, and they don't have to worry about the cap gains there, and that's a great opportunity in that piece. We've had people who have taken cars and donated them to their favorite charity for various reasons, either to sell or whatever. I mean, they're like, hey, I can get a better tax deduction than I can probably figure out in the hassle of selling this thing versus writing a check, and hey, they could use it. And this is a really important area. You have thoughts on that, Seth?
Well, I'm just wondering how many people in this season have been trying to donate their significant other's golf clubs. I think that would be my sister. Alan would not be very happy, but boy, he's done a great job of collecting multiple sets of golf clubs, and I've actually received the benefit of that. So cool. I'm very happy. They could probably write that off.
That would be a charity for your golf game, that's for sure.
Yeah. You can get really creative in this too. I mean, and I like the factor that there's time involved. Like people can really consider time a factor of investment and donating. But there needs to be an accountability for that, and sometimes that can be a challenge. I know that we've come across the charitable organizations sometimes really being very effective in serving the community or that they're dedicated towards, and having the other side of that really set up to get you a record of your donation can be a bit of a challenge too. So just being aware of that and giving enough time to allow them to do that. Yeah,
that's a very true statement. Just getting record of the donation that you did is something that's really important. Your CPA is going to need that, and they're going to need, like if you do a car, which is a pretty common item actually these days. If you do a vehicle, I mean, you have to have an approximate value of that vehicle that's documented and so forth, and you've got to have the VIN number for your CPA usually, and there's some work behind it and trying to get the true value, but usually it's a lot less hassle and it's significantly more appreciated sometimes. So,
state taxes, number 4. Did you owe state taxes when you filed your previous year's tax returns? If you did, don't forget to include the payment as a tax deduction on your current year's tax return. And some changes that have happened since 2017 is that there's a $10,000 cap on the state and local tax deduction.
I know, that SALT tax, man. That thing is painful for a lot of states out there. I know, New York, California, some of the higher, income tax rate states have really gotten hammered. I mean, Connecticut, the joke is that the SALT tax cut on 2017 that Trump instituted was basically an attack on the blue states. Essentially it really, really hit them hard. And it is very true that those are the states that traditionally have the highest state and local taxes, and that has really, really hampered them. But it's not just limited to them. It's across the country. That was one area where people pay a little more taxes. Making sure you account for that the following year is very crucial and something that is overlooked from time to time, even in some of the most seasoned tax professionals I've seen. That gets overlooked. Some of the other things that I have seen here, some people say, well, here's one area where it's cut. Well, I mean, there's a lot of other opportunities that were granted, which is the automatic deduction piece, that if you're married filing jointly, it went from $12,000 to $24,000 before you started itemizing anything. So we used to have to itemize if you're married filing jointly at $12,000 roughly and $6,000 if you're single. And now, if you're single, you start itemizing over $12,000. So you don't even have to have any bills or receipts. They just give you a $12,000 deduction automatically, which was increased. So there's some balancing out here that has really helped. I mean, if you rent an apartment or a house or whatever, the tax benefits of that 12 to 24 married filing jointly, that automatic deduction of $24,000, because you didn't have any of the mortgage deductions and any of that stuff. This is a huge increase that has helped a lot of people who don't make a lot of money, because they have these huge rent bills and they needed more deductions. They had nothing to deduct. Now, if you're highly charitable, that becomes significantly problematic, because unless all your deductions and your charitable giving goes over $24,000, whether you give or not, you're still getting the $24,000 deduction. Now, we're not CPAs, we're not tax advisors, but these are things that you need to have kind of on the forefront of your conversation with your CPA, like how to do that, where we've talked to people about basically rolling up their charitable contributions all into 1 year. You can do that and then give them out over 3 to 5 years. So you could say, hey, I want to push myself over that $24,000, and I might be getting a little in the weeds here, but if you said, hey, I normally give $10,000 a year to a charity, well, if you have $30,000 in cash, give it now, $10,000 each for the next 3 years. You instantly go over the $24,000 this year, plus your other deductions, and the following years you'll have the $24,000 for free, and you get that deduction automatically. So there's ways of manipulating this stuff inside these state taxes to really understand it. So I know I've gone into a tangent of federal stuff, but all of this ties together, and it's super important.
Well said, Ben. It does all tie together. And if you're really wanting to be winning at the tax game, it's going to take not one big kind of a landslide movement for you. It really is going to take several considerations. It's how do you eat an elephant, right? It's bite-sized pieces, and that's really how you win at the tax game. We're going to take a quick break. We've got 2 more for you, and we have time to actually talk about the final 2. So we're going to go ahead and invest the rest of our time with you here shortly, but we're going to take a quick break. We're talking about 6 most overlooked tax deductions and how you can take advantage of those this year. You're listening to Money on Tap. Don't go anywhere.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call 3-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. If you want to write us an email there, we really enjoy the feedback and your support, our listeners, whether you're catching us in a podcast or listening to us via radio. It is always a pleasure to connect with you personally, and we thank you for the calls and the emails. And some of our best conversations that we have here are because you've come to us and you've asked us some questions about maybe a topic that we've presented in the past, and it's given us a different perspective or a different insight into what's important to you and how we can get this information to you. That's one of the gifts that we enjoy giving here is how do you get into the brain of a financial planner and take advantage of that? What are some of the things that we look at on a regular basis to help our clients? And, you're an extension of that to us, and we want to make sure that you're getting something that's very valuable and timely for you to take forward into your personal finance journey. Today, we have been spending the majority of our time talking about 6 of the most overlooked tax deductions because, there is a whole bunch of them out there to look at. And if you're hunting for a job, if you have out-of-pocket charity, or if you have reinvested dividends, if you have state taxes that you owe when you filed previous last year's returns. Those are the 4 that we just spent some time discussing. The final 2 that we come to are Medicare premiums. Now, this is clearly something that doesn't apply to every part of the demographic that we're speaking to today. But if you happen to be eligible for Medicare or participating in Medicare, and you're self-employed and not covered by an employer plan or your spouse's plan, so you don't have the coverage, you're self-employed, you could be eligible to deduct premiums paid for Parts B and D, Medigap insurance and Medicare Advantage plan. The deduction is available regardless of whether or not you itemize deductions. That is a key.
Yeah, and basically, Seth, after what we just talked about right before the break and the itemization and how that works, this is completely outside of that. This is a big deal. This is something that you do not want to miss and say, oh, well, I don't need to worry about itemizing, because I get the $24,000 exclusion as a joint or a $12,000 as a single automatic deduction program. This is completely above and beyond that, irrelevant of that. So this is a big one, and if you're 65 and you're collecting, you're eligible for Medicare, and you have that, either Part B or D, you're not covered by an employer plan or your spouse's plan. This is like a free deduction. I mean, this is something you basically have to get no matter what, and it's just something you want to make sure you don't miss. A lot of people say, a lot of very unseasoned tax professionals will just basically say, "Oh, married, filing jointly, $24,000," and move right on, and they don't even inquire about this. It's just a silly little thing, but it's still a major tax benefit for you. Seth, it's funny. You were just mentioning something that I really just wanted to touch on because it's when people contact us. It is some of the greatest experiences we have because we get so much great feedback. Even when someone's not trying to give feedback, we get good, we get bad, we get all sorts of stuff. Hey, listen, you went too long on this. I wish you spent more time on this topic. It's like we're never going to make anyone perfectly happy. I mean, I think we figured that out just in this election season. But
it's only taken a few years for Ben and I to realize this.
Yes, exactly. But, reach out. Let us know where we can continue to refine. We love hearing that. I love when people come back and say, you know what, you really changed the way I thought about finances, or you really helped me, and I never thought of it this way. We don't care whether you do business with us or not. Just the feedback is great. So feel free to reach out, drop us an email, anything along any ways. But Seth, I'm going to jump into the last one here, number 6. We're kind of getting here to the end of the show. So this is an interesting one. So if someone dies, and this has to do with income from an IRA, all right? Now, this is kind of a tricky one, but there's been a lot of death, unfortunately, in our country, and our heart goes out to everyone in that scenario. But people inherit retirement plans all the time due to death. Their IRAs, the dad or mom's 401k or whatever it was. And when you get that income, it's important to know one really, really specific detail. Now, when estate taxes are paid during an estate, they add in every asset under the sun, including the value of your IRA, your Roth IRA, everything. And if there are estate taxes paid by the family, by that estate, you, as the inheritor of that IRA, when you take money from that, when you take the withdrawal from the IRA, you can deduct some potentially of those estate taxes that were paid against the taxes you're going to pay on that IRA because it's already been taxed federally. And this only is allowed on the federal side. Now, this is something, Seth, I got to tell you, almost all the time is missed. I mean, this is missed. If this isn't the number one clincher to why you listen to our show, when you either inherit today or just did or will in the future, and your family has estate tax issues. Now, the estate tax exclusion obviously is very high in the tens of millions this right now, but I am of a belief, as many attorneys are, that that estate tax exclusion is going to drop significantly in the future to deal with taxes. It's just been something that has been challenged and challenged and challenged, and it's just never been made permanent enough to solve that. And I think we went from 600,000 to like 11 million a person, and it's crazy, and it's not going to stay that high. I just really don't believe it. And when your family does pay estate taxes, it's important when you're dealing with that IRA and you're taking your distributions out over 5 or 10 years that you're allowed to, you need to know what those taxes are. Now, this gets complicated because in large families, there's, one person who's usually running the estate, and there's just lots of information needed, and figuring it all out and getting that information can be complicated because of, family dynamics and so forth. But there's just a lot there. And if you're inheriting an IRA and you're dealing with this problem, this is something to give us a call, because there's a lot of kind of, getting a map out and navigating these waters is and can be tricky. So this is an area that, if you're listening to our show, we just given you probably a huge tax savings idea right now.
Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast. You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. We appreciate you joining us here today, and we hope you make it a great day and a great life. Thanks for joining us with Money on Tap.
On this Cliff Notes edition of Money on Tap, Seth and Ben talk about the possible benefits of early retirement.
Moving that timeline forward, okay, and that could be as early as 50. I think that's about the earliest that we typically start having this conversation, or seeing people starting to have this conversation with us of what if or could I? If that's you, or if that's close in your horizon, you want to pay attention mostly to what Ben's going to say, because, truly he brings the meat of the show. But there's going to be nuances here that you just haven't even considered. And considering the factors in here and accounting for the factors in here is one of the important pieces to being successful at this, right? It's you don't want to jump in on a vacation to, I don't know, for you, Ben, it's Bermuda, right? That's the spot. For us over here on the West Coast, we're going to Hawaii or someplace warm. You don't want to jump into that and realize you didn't bring your suitcase. You didn't plan at all.
Well, Seth, I think early retirement has definitely gotten more of a tap on the shoulder recently than most of the time in the past. I mean, we meet people constantly who say, yeah, I want to retire at 50 or 55, or I don't get a lot of people in the 40s, but once in a while I do. They ask us to create and craft, and some of those are big buyouts from companies or tech companies. And but more recently, with this pandemic scenario and everything that's going on, there's been a lot of offers by corporations for early retirement incentive, and that's going to people who are under the 59 and a half age, as Seth had mentioned. We traditionally, people are looking at 60 years old as an earliest retirement because they want to avoid the 10% tax penalty for taking money out of their retirement plans before they're 59 and a half, which is the tax law. So when you have an IRA, you have to pay income tax on those distributions, but when you're under 59 and a half, you have to pay a 10% penalty. Now, there's a couple ways that we've talked about in the past on this show where we've done shows on 72T and 72Q, which have to do with early distributions prior to 59 and a half, and that's for qualified and non-qualified assets. Well, 72T, which is for qualified assets, which is that you can take money out of your retirement plan prior to 59 and a half and not pay a tax penalty, has been pretty much the mainstay for a lot of people, and that's because you have to take income, and you take income over equal and subsequent payments. And what that means is there's a calculation that the IRS does, or you have done, that the IRS has given us, and your CPA is usually the person who does it, and they calculate an equal payment that you'll receive from the age you are, basically to the infinity of spending the money. And you have to keep that payment equal until you turn 59 and a half. So you have to choose to take this payment. And that has been what everyone has done planning around. And 72Q has very similar rules and so forth, but it's for non-qualified assets or assets that you invested with money after you were taxed on it. So you got paid the money, you put it in your savings account, and you decide to invest into an annuity. You can do the 72Q with that. And you have to do the exact same thing to avoid the 10% penalty that the IRS has on those funds. Now, that has just been what we've done. But recently, with the CARES Act, we've had a bunch of changes, and Seth's going to chat a little bit about that.
Right. So, first of all, what was the CARES Act? Okay. And how do you qualify? So, CARES Act was passed in order to allow hardships right now that we could be experiencing to grant access to qualified money, that 401k money, that IRA money, right? Which typically, as Ben mentioned before, if you're to take that out prior to 59 and a half, if you're not using the 72T or Q method, it would get you a 10% penalty right out of the gate. Okay, so what they're saying is we're going to do away with that, and we're going to allow you access to your 401k up to $100,000 for you to go ahead and grab that in the event that you have something that qualifies you to do this, okay? Right now, you've got a stable job, let's say. That does not qualify you, right? But if you did happen to test positive or have some kind of a health incident that would get you into this qualification to be able to take up to $100,000 out of your 401k, right? Now, there's, of course, some guidance and some other pieces that you have to be paying attention to with this. Is it $100,000 that you just can go do whatever you want? You're like, oh, great. Hey, got $100,000 here. Is it tax-free? All these other considerations here. So the answers to this are A, no, it is not tax-free. However, you can break that $100,000 up, or whatever it is that you take under that $100,000 up. You can break that taxability into 3 years. Okay. So it's still, depending on where you're at in your circumstances, it could still put you into a taxable scenario that doesn't, for you, look favorable. Okay, so that is one of the first considerations that you want to understand there. Okay, we're not going to get into necessarily all of the qualifiers here. There's a list of what you could qualify or what could get you into the qualification corridor here. The point that is really of most note and interest is that you're not going to get a 10% penalty for an early withdrawal there.
Seth, I read these qualification exemptions, and I'll tell you, it's pretty broad, though. It's not like you had to lose your job. It's like a job offer was rescinded, you were quarantined, furloughed, you lost money or your self-employment income. I mean, it would be hard for you to not qualify. I mean, I think everyone has had a business interruption here from COVID. I mean, I can't imagine you can't say you haven't. You'd be really hard pressed to say that COVID did not impact your business in somehow, some way. Be like, we lost productivity because we couldn't get employees into the office and we had to do everyone remote. And yeah, our income dropped 3%. I mean, there's still an impact there. And so there's a lot of opportunity to create that. I read those rules and I read those as having huge breadth of of opportunity for people. But I was thinking about this and saying, husband and wife married, wife maybe doesn't have a retirement plan. Husband does. They've had a financial impact. They can take out $100,000 from his retirement plan. If she loses her job, there's clearly an opportunity to take that money out. But it's actually $100,000 per person, which is interesting as well.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.